What is short stock? There are many ways to make money on the stock, one of them is short stock. It is the process where an investor borrows some amount of stock from the lender, sells it to the market at its actual price, waits to get the price down, rebuy it, and then simply gives it back to the lender, with having a profit of his own. Short sellers bet that the stock they are selling will drop in price in the future. If the stock drops, they buy it back at that price lower than before and gives back to the lender, with the profit that he made between the selling price and buy price. How to short a stock? To open a brief position, a trader must have a margin account. He usually has to pay interest on the value of the borrowed shares while the position is open. Also, the Financial Industry Regulatory Authority, which enforces the rules and regulations governing registered brokers and broker-dealer, has set minimum values for the amount that the margin account must maintain. If an investor's account value falls below the maintenance margin, more funds will be required, or the broker can even sell the position. To close a short position, a trader must buy the shares back on the market, hopefully at a lower price than the borrowed price as the trader expected, then returns them to the lender or broker. The broker will handle the process of locating shares that can be borrowed and returning them at the end of the trade. Behind the scenes, opening and closing of the trading system are usually made through the regular trading systems. However, each broker might have restrictions or conditions the trading account must meet before they allow margin trading. Pros, or short selling for a profit. Possibility of high profits, little initial capital required, leveraged investments possible, hedge against other holdings. Even though it is a risky process, short sellers are betting that a stock will drop in price. It is riskier than going long on a stock because there is no limit to the amount you could lose. Short selling is the process that can be used for both speculation or hedging. Speculators use short selling to capitalize on a potential decline, while hedgers use the strategy to protect gains or minimize losses. Cons or risks. Potentially unlimited losses. Margin account necessary. Margin interest incurred. Short squeezes. Short selling involves great risk because when an investor buys a stock in the long term, they might lose only the money they have invested. When an investor short sells, they can theoretically lose an uncountable amount of money because a stock's price might keep rising forever. Conclusion. Short selling is very risky, hence many might not use this strategy because most of the time the investor thinks the price might go up and bring them loss. Even though the stock market faces some downfalls, but in long term, it tends to go up. Many investors consider buying stocks rather than short selling them as it's less risky, but it can bring investors an amount of profit if the investor is sure that the stock will go down in price by looking at some factors that make it visible. But again, be careful with short selling as it can be a lucrative way to gain profit if a stock drops in value, but only if it's attempted by experienced investors. Even after that, it should be used sparingly and only after a careful observation of the risks involved. That's it for today. I hope you find this interesting. Thank you for watching. Please like and subscribe for more videos.